If you've been trying to make sense of the Melbourne property market, it's completely understandable to feel conflicted. Now, one day it's being labelled as a recovery story, and the next it's criticised for being lagging behind. And for investors trying to cut through all of this noise, it's easy to lose sight of what actually matters. This video isn't about jumping on any bandwagon or predicting any boom. It's about pausing, taking a more objective look at all of the data available to us and understanding the long-term signals. We'll walk through what the historical data is actually saying about Melbourne's position today. We'll look at areas that are showing signs of movement and which areas aren't really moving at all, the risks and limitations that are still present, and what it means for investors for the back half of 2025 and beyond. If you're someone that values evidence over opinion and wants to understand the market based on first principles, not just what the news headlines are saying, then this video is for you. Hi, my name is Luke Cheng. I'm the head of research at Liviti. I'm a researcher, a strategist, and multi-property investor. And together with our 55 staff and counting, we've helped over thousands of Australians purchase property. And today, I want to help you take a step back from all of this noise and look at Melbourne through the lens of fundamentals, not forecasts. We've reviewed hundreds of suburbs and over 7,800 data points in Melbourne, so let's begin. One of the strongest indicators we have for Melbourne's potential is its historical tendency to follow Sydney. This means that when Sydney cools or heats up, Melbourne often follows. This trend is evident from 1995 all the way up till 2022. And this alignment isn't just about headline price movements. It's deeply tied to a shared set of fundamentals that have historically shaped the long-term demand and resilience in both of these markets. Understanding these drivers help us see why Melbourne's current buyer's market is so compelling, because the underlying fundamentals are setting the stage for the next growth phase. We're seeing that set up again right now. Many of you watching may actually know this from watching our weekly webinars. The link is in the bio if you guys are interested. So let's get into the numbers that we're seeing in Melbourne. The first thing we're noticing is how much Melbourne is undervalued compared to Sydney. In fact, it's around 20 to 40%. Headlines are correct in saying that Melbourne's suburbs haven't really moved much since 2022. Areas such as Craigieburn, Tarnee, Epping have really taken a back seat to Brisbane and Perth, drawing more of that attention in 2022 and 2024.
With Melbourne now ranked as the third most affordable major city,
now presents a real opportunities for buyers who have been priced out of Sydney, Brisbane, and Perth markets. In fact, the same affordability headline is what drove investors to Perth and Brisbane in 2020 to begin with. Now, despite Melbourne being more affordable, vacancy rates are still under control. Supply is usually a concern in any new growth corridor, but with vacancy rates sitting well below 2%, these same growth corridors in the north and the west side of Melbourne are seeing a significant supply and demand squeeze, despite new approvals and buildings. And because of this, the rental surge because of the high owner-occupiers is apparent. For most of these suburbs in the growth corridor, owner-occupiers are purchasing majorities of the properties there, meaning that renters have very limited options. And for many of the suburbs that fit this mold, we're seeing weekly rents surge over 20% over the past 12 months, according to SQM. Another thing to consider is affordability. Melbourne is now no longer the second most expensive city. We're noticing that people aren't even aware that there are 3 to 4 bedroom opportunities 30 kilometers away from the CBD that can be purchased for well under $700,000. These are properties offering yields north of 4.5% and in some unique cases up to 6% depending on what that property is. The thing we're most excited about Melbourne is its sustained demand. Melbourne, which overtook Sydney as Australia's largest city in 2022, has sustained its position as the country's most consistent in-demand property market. While cities like Brisbane, Perth, and Adelaide, they've seen sharper short-term price gain, but Melbourne's sustained demand is anchored by its population size, steady migration flow, diverse economy, and world-class infrastructure. So let's take a look at some standout example suburbs. Tarneit, currently with a median house price of $650,000, has tight vacancy and a population forecast of 164% increase by 2041. This area lies within 30 kilometers of Melbourne CBD, serviced by existing rail infrastructure, and is positioned along the West Growth Corridor, a region expected to benefit from the future suburban rail loop developments that's now in the planning phase. Overall, it's a good combination of existing infrastructure, future planning, and sustained demand by a large amount of population growth expected to come here. Then we have Clyde North. Sitting just over $700,000 for a 4-bedroom home, Clyde North follows this same logic and is one of the fastest growing residential corridors in Victoria. Backed by major retail, existing transport, and future road infrastructure all underway. Better yet, out of the whole population boom that's coming to the city of Casey, Clyde and Clyde North is expected to house a majority of that upcoming demand. Next up, Mickleham. Mickleham, situated in Melbourne's North Growth Corridor, is emerging as one of the best places to be, with median house prices around $640,000. Major projects such as new schools, community hubs, freeway upgrades, and the future train line is positioning Mickleham as a key part of the government's plan to accommodate for the next wave of population growth. And the real big game changer, the Merrifield City project, set to be 5 times the size of Melbourne CBD. This alone will transform that whole region, along with all of the suburbs nearby, into a major economic and lifestyle hub. Now, this doesn't mean we're limited to these 3 suburbs I just shared with you. I want to show you guys a couple of recent purchases we've made for our clients. We've got a client that purchased a 4-bedroom, 2-bathroom home in Pakenham for $520,000 back in August 2023. And recently we got a valuation and it came back at $640,000. That's a 23% increase in value, adding $120,000 in equity since his initial purchase. On his initial deposit, that's a 230% return on investment. Another one of our clients, Carla, also purchased a 4-bedroom, 2-bathroom home in Werribee for $500K back in February 2023. And today, it's worth $650K, meaning a 30% increase on property price, $150K in equity, and a 300% return on her initial deposit. Speaking of location and land supply, here's where things get a little bit more interesting. Land supply is one of those things you can't scale overnight, and in Melbourne, it's already tightening. According to Victoria's Urban Development Program, some of these Melbourne growth corridors, the suburbs like Wyndham, Melton, and Casey, are facing less than 4 years of zoned and serviced land. And comparing this to pre-2020, that was 10 to 15 years buffers at that point. We're also seeing a sharp decline in new lot releases. The Urban Development Institute of Australia reported a 49% drop in greenfield land supply across Melbourne between 2021 and 2023. On top of that, median lot sizes have also decreased, suggesting that developers are compressing supply due to availability and council approval. And that's not just a short-term blip either. Developers are now contending with slower approvals, utility servicing delays, and zoning bottlenecks in many of these growth areas. Fewer projects are entering the pipeline, and naturally, that puts a compounding strain on existing supply. It's almost a mirror image of what happened to Sydney back when they had their major price run. Supply tightens, approvals stall, and prices start to move well before the broader market really catches on. Now, if you want to get ahead of the curve, you should also look where government is spending money, because it's where jobs, transport, and long-term value usually follows. And Melbourne's $120 billion infrastructure pipeline is one of the most aggressive we've seen since Sydney's transformation began a decade ago. So once again, we're seeing that $550K to $700K to be the hottest price band for growth. Why? Because it's where most people can actually qualify for. Especially with 2 rate cuts now already behind us and more potentially on the way, as borrowing capacity expands, this price band will see the sharpest rise in buyer activity. And that demand isn't speculation. It's structural. So when you combine affordability that still exists in Melbourne for now, infrastructure under construction, tightening land and planning policies, and a huge wave of new buyers re-entering the market as rates fall. It's not a matter of if growth will happen, it's how quickly it will. In other words, we're reading the same signals that played out in Sydney when Sydney was affordable. If immigration keeps rising, which it already is, net overseas migration projected to surpass 300,000 in 2025, rates continue to drop, borrowing capacity increases, and new government incentives taking place in January 1st, we're expecting the best performing pockets in Melbourne, especially at the price range of 550,000 to 700,000, could well exceed 8 to 10% in capital growth in the next 12 to 18 months. Now, everything we've covered so far paints a pretty strong case for Melbourne, but let's not pretend it's perfect. Like any market, there are trade-offs, and Melbourne might not suit every investor's goals, especially in the short term. So let's talk about a few things to look out for. First of which is rental yields. While some outer growth corridors are delivering yields above 4.5%, Melbourne still trails markets like Perth and other parts of regional Queensland where yields are naturally exceeding 6%. If immediate positive cash flow is in the top of your priority list, you may find stronger near-term returns elsewhere, especially if your budget allows you to do so. The second thing to note is Melbourne is a long-term play. You're not likely to see overnight gains or fit for a strategy where you're buying and selling property every single year. A long-term strategy backed by solid research, planning, and patience is key here. The majority of all of the government plans that we've looked at, we're looking at 10 to 15-year plans. And this is a must to be considered when investing in Melbourne. The third factor is growth isn't universal. Not all parts of Melbourne will perform equally. The growth suburbs we've highlighted in Mickleham, Tarney, and Clyde North are supported by strong fundamentals and demographic data. In contrast, inner city apartments, especially those closer to the CBD, may initially appear as a great deal, but historically follows a slower path compared to the higher demand areas outside of the CBD. And fourth, of course, Victoria's land tax. For investors in Victoria, it's important to factor in yearly land tax now. Rates start at approximately 0.2% of land value paid every single year. For most of our investors buying around 600,000, we're looking at an extra 650 to 1,200 per year. And realistically, that's only about $20 a week. So here's the main takeaway. If you can manage that, or even cover it with a bit of extra rental income, you're in a really strong position. None of these trade-offs negates Melbourne's potential, but they do showcase the importance of entering a market with a plan, knowing the exact numbers, and not assuming that all markets and properties are going to perform the same. Because the people who are now seeing results, they moved in early, they moved in strategically, and some are sitting on six-figure equity before settlement even occurs. They're not guessing, they're combining finance and property decisions together. And they understand that growth comes to those who position themselves early, not those who have found the perfect location, perfect timing, or even the perfect property. If this is the mindset that you are bringing, Melbourne is looking to be the most compelling play for you heading into 2025. So what does that mean for property investors? 2025 could be the year we see investors return to Melbourne with a bit more confidence. We've already seen rents reach record highs, and in many of these outer ring suburbs, it's now possible to find deals that are neutral or even positively geared. Something that was almost near impossible just a few years ago. Take a 540,000 house in one of our high yield locations, renting for about $550 a week. With a 6% interest rate and interest-only lending, after tax, we're seeing properties that are brand new, under market value, with positive cash flow, while getting about $7,700 back in tax every single year. But beyond cash flow, these opportunities are exciting because of its equity growth potential as a buyer's market. But this kind of setup doesn't last long. So the key here is to be selective. Look for suburbs that have tight vacancy rates, good infrastructure, really strong future demand. Areas with a high mix of owner-occupiers tend to also perform better for the long term. And that's where we are seeing Melbourne today. All in all, Melbourne's showing signs of having turned over in this cycle, with affordability, infrastructure, investment, and structural demand all pointing in the right direction. But like any market, the opportunities depend entirely on how it aligns with your strategy. So the next best step for you, step back, map out your goals and timelines. Know how much you can borrow, how much things will cost to hold. Identify the types of assets that will suit your position. And then, and only then, assess whether Melbourne plays a role in that plan. If you guys need a second opinion, we've left details below for you guys to book a call. But outside of that, thank you for tuning in, and we'll look forward to seeing you in the next video.